Civil negligence lawsuits are inherently abrasive, unpredictable, and slow. Workers' compensation replaces that legal friction with mathematical predictability. This logic stems from the 1911 Grand Bargain. In a move designed to stabilize the industrial era, employees surrender their right to sue for negligence in exchange for guaranteed no-fault injury compensation. This framework functions as a multi-layered legal and economic architecture designed to process liability through fixed protocols. For safety officers, mastering this system creates a nexus between three disparate domains: incident prevention, legal record-keeping, and corporate risk management. Navigating this architecture allows a risk manager to convert unpredictable incident outcomes into a manageable financial trajectory. Every potential claim hits a primary logic gate, the course and scope threshold. To trigger the circuit, an injury must both arise out of and occur in the course of employment, often abbreviated as AOE-COE. If a worker drops a heavy steel pipe on their foot while moving inventory during their shift, the logic gate opens instantly. The link to job duties is direct. Modern work environments complicate this gate. Proving liability for an injury that occurs at a home office desk during a Zoom meeting requires a more granular level of evidence. In remote cases, the legal burden centers on proving the specific hazard was inseparable from the employer's dictated workspace requirements. Geographical and temporal boundaries define the scope of liability. An injury occurring outside these verified limits starves the circuit of financial momentum. The system immediately rejects idiopathic conditions, physical events like a heart attack that would have occurred regardless of the worker's presence at the job site. Behavioral exclusions also apply. Injuries caused by intentional self-harm or significant departures from work duties, such as horseplay, invalidate the no-fault protection. This boundary logic includes the coming and going rule. Routine travel between a worker's home and business is excluded. Coverage only resumes if the employee is on a special mission or if the contract includes company-provided transportation. Maintaining strict situational boundaries is a safety professional's first line of defense against unwarranted entries into the liability circuit. Once a claim clears the logic gate, the system distributes financial liability across four specific output nodes. The first node is medical costs. Statutes mandate the employer provide 100% of reasonable and necessary care, with zero deductibles or out-of-pocket costs for workers. The second node, wage replacement, provides a financial bridge while the worker recovers. This is categorized as either temporary total or temporary partial disability. Temporary total disability, or TTD, is typically calculated by taking the employee's average pre-injury pay and multiplying it by roughly 2/3. This formula is finite. TTD payouts are limited by state-specific caps, meaning identical injuries can have vastly different total costs depending on the jurisdiction. If an injury results in lasting impairment, the system triggers nodes 3 and 4, permanent disability, scheduled losses, vocational retraining, or survivor benefits in the event of a fatality. These outputs generate the raw data that determines an organization's ultimate financial liability. Employers frequently attempt to block these payouts by citing safety protocol violations or suspected intoxication. However, in a no-fault architecture, the legal burden for an intoxication defense is extremely high. Toxicology must prove that intoxication was the sole cause of the accident. If a workplace hazard, like a faulty machine, contributed to the event, the claim typically remains compensatable. Because the system defaults to employer liability, relying on post-incident fault assignment is an unreliable strategy for cost control. Workers' compensation insurance operates through a variable premium model that reflects real-world safety performance. The system uses a specific feedback loop to adjust costs, the Experience Modification Rate, or EMR. The industry average is 1.0. An EMR greater than 1.0 acts as a multiplier, triggering multi-year premium penalties. High claim payouts from previous years will exponentially inflate current costs. Insurers verify this risk profile by auditing a company's OSHA 1904 record-keeping logs. This requires precise record management, as OSHA recordability and workers' compensation compensatability rely on distinct legal definitions. Despite these differences, insurance auditors scrutinize both data streams to calculate the final premium risk. A single unmanaged claim can dictate the organization's operating budget for several years. Safety officers have the power to stop the rapid accumulation of indemnity costs by immediately engaging the Return to Work or RTW program. Providing transitional or light-duty roles that accommodate medical restrictions immediately halts the temporary total disability payouts. This protects the company's EMR while simultaneously improving the employee's long-term physical and psychological recovery. Cost recovery also includes third-party subrogation, reclaiming claim payouts from a manufacturer if a defective product caused the injury. Proactive management during the recovery phase shifts the financial trajectory, preventing the EMR from reaching penalty levels. Legislative bodies are currently expanding the AOE/COE threshold to incorporate psychological trauma. Mental health claims have moved from first responder exceptions to a central component of the compensation system. Data shows a significant trend. 36 states cover mental stress claims, and legislatures introduced 86 bills to expand benefits in a single year. This shift heavily impacts first responders and healthcare sectors, where PTSD and severe stress claims are increasingly compensable without a physical injury. Safety officers must incorporate employee assistance programs and psychological hazard assessments into their standard risk protocols. Modern safety strategies must account for the nonlinear, often high-cost nature of psychological rehabilitation. The original grand bargain still supports the foundation of workplace liability, but its variables are increasing in complexity. Basic OSHA compliance is no longer a sufficient shield for an organization's financial health. Mastering the architecture of workers' compensation allows a safety professional to mathematically model and mitigate an organization's long-term liability